Welcome to Trader TV, your insight into trading for professional investors. I'm Dan Barnes. We're seeing automation increase across both the buy and sell side across different asset classes. Joining me today is Charlie Campbell-Johnston, Head of Integration and Workflow Solutions at Tradeweb, to talk about which trades he's helping to automate and which trades can't be automated. Charlie, welcome to the show.
Thank you, Dan.
Let's start with the parameters which guide best execution. What sort of objectives might a trading desk have, and how might they be affected by the types of funds and portfolios they're trading for?
No two trading desks really have the same set of parameters, but broadly, it will be a combination of certainty of execution, speed, price, i.e. transaction cost. But yet there will be different clients or fund managers then with different trading objectives. So for example, one use case would be an index house looking to trade at month end, high volume of tickets over a short period of time. Certainty of execution and speed are pretty important. If you've got a more active fund manager, for example, transaction cost is likely to be far more of a consideration. So the ability to limit your transaction costs, either in cash terms, basis point terms, and so forth, potentially at the expense of a likely higher hit rate, may be more appropriate. And we'll tend to work a lot with clients to be able to define those rules on an order-by-order basis to basically be in tune with those execution objectives. The other thing I would say is that on the back end, it's really important for a trading desk to be able to prove to their own clients that they've acted in accordance with these rules. So people will often use our transaction cost analysis tool to say, this automated rule set has had a positive impact on our transaction costs, and therefore we could potentially look to extend it into other asset classes or other use cases. If it's a question of comparing against the close or maintaining a client hit rate of a certain level, again, those same tools can be used for that same objective.
Do you typically see different execution parameters that are specific to certain asset classes?
One of our largest asset class adoption is in the ETF space. Quite often, ETF traders come from equity backgrounds, so they have a different approach to automation. Automation seems very much as something that should be embraced. In that use case, for example, speed is important. There's less concern about market impact because these things are quite often traditionally traded on exchange. But if you go further down the liquidity spectrum, there may be more considerations about, should I be showing my RFQs to the whole market? Should I be showing my side before I trade? For a fully cross-asset class desk, or even one that trades as single asset classes, but with a wide range of liquidity within that asset class, an automation tool needs to combine really a commonality of approach. What I mean by that is from a technical or a workflow perspective, you're able to start off in one asset class and potentially move into other asset class without doing a completely new build. So if you have a full understanding of what technical things you need and the workflows that are available to them, this then allows you to dip your toe in the water in something that you're very, very comfortable with, and then rapidly expand as you get used to it, whilst also understanding that there are different nuances in different asset classes.
In terms of the barriers to success of a trade, how does automation specifically overcome those?
I think this depends on the definition of success and what the trading desk is looking to achieve. If it's purely a scale play, the benefits are clear. Increased capacity, decreased operational and transaction costs. The trader's role is still paramount, but the nature of what a trader is doing is changing over time. A lot more integration with market data sources and analytics, but also from the original use case of a capacity issue, we're seeing that automation is actually bringing new types of trading activity to the fore. One example would be the use of systematic funds in the leverage space, being able to use automation to trade in a different way that they had before. And to that point, if you are looking to set up a fund, what we've built is the ability to be able to integrate into our automated tool direct from a trader's spreadsheets. So the setup costs, which previously had been the implementation of an order management system or an execution management system, can now be removed if someone wants to get up and running very, very quickly. So, for example, we've seen a marked increase in the index space of people using a functionality that allows orders, what we call time release orders, to be sent out at a certain point of the day. That allows a trader to trade at a very specific time with specific execution objectives, often in a very busy time that allows them to free up time for other kinds of trading activity. The focus on that may be to get a large amount of trades done at a certain amount of time at the closest point to the close. Automation works well when markets are benign. Okay, so when counterparties have their auto quotas on, you can be pretty confident of getting responses from a certain amount of counterparties according to certain conditions. But what we found, particularly about this time last year when the COVID crisis started, is that people want to be able to adapt those to say, still use automation, but be able to adapt those rule sets to varying market conditions. In volatile markets, a hybrid model, if you like, a sort of a light version of automation, is something that really comes into its own, so that traders can still benefit from the full array of parameters, settings, and so forth, but have that last-minute control to say, okay, I'm prepared to pay a little bit more bid offer spread. I'm prepared to wait a little bit longer. And we've seen that trend continue quite significantly, but particularly when things are a little bit more challenging.
How can traders ensure that all the right factors are in place to allow them to start building an automated trading capacity?
Working with a trusted partner with experience in this space does give you a little bit more comfort on that. Second, even though these trading desks do have various different trading objectives and so forth, they still have the same things that they need to address. They want to be able to know that the partner they're working with has the experience to understand that, but also has worked with people like themselves to be able to get a little bit of an understanding of what options are available. And that's important for us because it means that the nature of our interaction with clients is very much a collaborative innovation, so that we can make sure that we are designing protocols and so forth that fit in with not only one client's objective, but also understanding how that can be sent out to other people.
Which trades can't you automate?
The time may not be always appropriate for certain people, particularly in times of high volatility. There may be a full retrenchment from automation. But what we have seen is that those who've adopted it have been flexible enough to understand how they can adopt it and not overly rely on it to make sure that they can use it as part of their overall desk strategy.
That's been great, Charlie. Thank you.
Thank you very much, Dan.
I'd like to thank Charlie for his insights today, and of course you for watching. To catch up on our other shows, also subscribe to our newsletter, go to tradietv.net.